Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Palantir.
If you find our talks useful, please consider subscribe, like, and comment underneath because today you are really going to want to take notes.
Yeah, definitely.
Because imagine a company that, actually grows faster the larger it gets. It completely defies the basic laws of business physics.
It really does.
And today we are staring down the barrel of May 4th, which brings us to Palantir's Q1 2026 earnings. And I think we really need to set the stage here because for years, Wall Street kind of dismissed this company.
Right, as a glorified consulting firm.
Exactly. A secretive, lagging narrative stock that just required way too many human engineers to ever scale properly. But something structural broke inside their business model over the last 2 years.
Yeah, they transformed into this fundamental AI hypergrowth engine.
So our mission for this deep dive is to pull apart the mechanics of that shift.
Yeah.
We need to figure out if this current consolidation phase we're seeing in the stock price offers a legitimate wealth-building opportunity for your portfolio.
And, the shift in how the market views this business is historic. It really is. Wall Street didn't just change its mind because of some slick marketing campaign or a new logo.
Right.
The fundamental reality of their cash flow and their growth metrics just became mathematically impossible to ignore.
Well, let's talk about those metrics because when you look at enterprise software, companies usually hit a growth wall as their revenue base expands.
Exactly, yeah. It is very hard to double your revenue when you are making billions compared to when you are only making millions.
Right, the law of large numbers kicks in. You naturally decelerate. But Palantir seems to be somehow accelerating as it gets heavier. What is the actual mechanism driving that?
It's all in the numbers. I mean, going from 17% growth back in fiscal year 2023 to a 56.2% year-over-year increase in fiscal year 2025 is just absurd.
But 56.2%.
Yeah. We are talking about total revenue hitting $4.48 billion.
Wow.
And the momentum is compounding. If you zoom in on their fourth quarter of 2025, they posted $1.4 billion in a single quarter.
Just in Q4.
Just in Q4. That was up 70% year over year, which marks 10 straight quarters of acceleration.
10 quarters. That's incredible. So where is all that coming from?
The engine driving this anomaly is their U.S. commercial segment. That specific division surged 137% in Q4 to $507 million.
I really want to pause on that because growing 137% at that scale, it's like having a nimble, hyper-growth startup hidden inside this giant corporate machine.
That's a great way to look at it. And to understand how they achieved that, you have to look at their go-to-market strategy with their artificial intelligence platform, or AIP.
The boot camps.
Exactly. They completely stopped trying to sell software through traditional months-long PowerPoint presentations. Instead, they just started running these AIP boot camps.
I want to break down those boot camps for you listening, because that seems to be the linchpin of this whole story. Instead of sending a sales team out to, pitch a hypothetical product, Palantir brings the client's executives into a room.
Yeah, and they take the company's actual messy, siloed data.
Right, the real data.
Yeah.
And within 3 to 5 days, they build a fully functional, custom AI application right in front of them. The executives literally leave the boot camp with a working tool that is already saving them money or, optimizing their supply chain.
It's brilliant because it collapses a massive enterprise sales cycle that usually takes 18 months into less than a week.
That is just wild.
It is. And while that U.S. commercial segment is operating like this explosive startup, their foundational U.S. government business is still quietly acting as an institutional bedrock.
Right. We can't forget the government side.
Exactly. That segment solidly rose 66% to $570 million. So having that commercial startup growth running in parallel with massive, reliable government contracts, it translates directly to the bottom line.
And they're doing all this with a fortress balance sheet, right?
Oh, absolutely. Zero debt and a cash pile of up to $7.2 billion. But the metric that really forced Wall Street to pay attention is the operating leverage. As they scaled this revenue, their operating margins literally tripled from 10.8% to 31.6%.
Which generated, what, $1.63 billion in GAAP net income?
Exactly.
But let's pause on the cash flow, because $2.1 billion in free cash flow for FY 2025 is a 47% margin.
Yeah, 46.9 to 47%.
Generating 47% free cash flow margins in the enterprise software sector is practically putting a giant neon target on your back. Like the Microsofts or Amazons of the world should be eating their lunch right now to steal those margins.
You'd think so, right?
Yeah. So how is Palantir not just being crushed by big tech?
They survive, and honestly, they thrive because of something called ontology lock-in.
Ontology lock-in. Okay, explain that.
So when we talk about an ontology in this context, we aren't just talking about a place to dump your files. It is this highly complex data structure that maps the physical and logical relationships across every single silo in a corporation.
Okay, so it connects everything.
Right. Think about a massive manufacturing company. Palantir doesn't just store the spreadsheet of parts. The software actually understands that a shipping delay in a specific port in Asia directly impacts a factory floor schedule in Ohio.
Oh, wow.
And then it knows that that delay alters the quarterly revenue forecast for the European sales division. It gives raw data, actual, actionable business logic.
To make sense of this, I always look at the competitors out there like Snowflake or C3.ai. If you think about Snowflake, it's like a massive, beautifully organized digital warehouse, right?
Yeah, exactly.
You can store millions of boxes of data there, and you can retrieve them incredibly fast. It's essential infrastructure. But Palantir's Ontology feels like the highly intelligent logistics manager walking that warehouse floor.
That's a perfect analogy.
Right. Like it knows exactly what is inside every single docs, how the contents of box A interact with the contents of box B, and how moving them around actually makes you money.
It perfectly captures the divide. Because Snowflake is dominant at the data storage and compute layer, but they lack that deep operational logic layer.
And what about C3.ai?
Well, when you look at companies like C3.ai, they are currently struggling with heavy deployment friction and shrinking margins precisely because they haven't achieved that structural embedment.
Right.
Once Palantir's logic layer is woven into the daily, minute-by-minute decision-making of a Fortune 500 company, ripping it out is basically like performing a lobotomy on the corporate nervous system. The switching costs are just too painful.
Yeah, that is a strong moat.
Yeah.
But that's just the commercial side. If we pivot over to their government contracts, that moat seems even wider. We always hear these acronyms thrown around, IL6, IL5, FedRAMP High. Those aren't just pieces of paper you fill out online, are they?
Far from it. Achieving Impact Level 6, or IL6, is this brutal, exhausting process that takes years and literally hundreds of millions of dollars.
Hundreds of millions, just for the certification.
Yeah, because it requires building physical, air-gapped server infrastructure. It means surviving endless bureaucratic audits from the Department of Defense just to prove your systems can handle classified, secret-level national security data without being breached.
Wow. So it's a massive barrier to entry.
Exactly. A brand new AI startup with a really great algorithm simply cannot walk into the Pentagon and bid on a classified contract. They don't have the clearance.
But Palantir does.
Palantir does. It acts as a structural monopoly that just blocks out disruptive newcomers.
So let's talk about the macroeconomic environment that feeds into that government moat.
Okay.
Because their forward guidance for FY 2026 is projecting revenue between $7.182 billion and $7.198 billion.
Which implies roughly 61% growth.
Right. And you don't project 61% growth at a $7 billion scale unless you have massive secular tailwinds filling your sails.
You definitely don't.
And regardless of where anyone stands politically, as investors, we just have to look purely at the math of government spending. President Trump's recent $1.5 trillion defense budget is a factual, undeniable catalyst for companies embedded in the defense sector.
Absolutely. That $1.5 trillion budget fundamentally upgrades Palantir's status. Specifically, you have to look at the $175 billion Golden Dome Missile Defense Initiative.
Okay, what is their role in that?
This is where Palantir's software truly shines. They specialize in integrating sensor-to-shooter technology. So, in a battlefield scenario, a radar detects an incoming threat. The AI instantaneously calculates the trajectory, checks the inventory of defensive weapons, and tasks a specific battery to fire.
And it does all this autonomously.
All in milliseconds. That capability guarantees a massive floor for government AI spending. It completely shifts Palantir from being like a discretionary software purchase to a strategic, non-negotiable vendor.
The military literally cannot run modern algorithmic warfare without that operating system. That transition from a nice-to-have software to a must-have weapon system is huge. But there's also some wild, unconfirmed, speculative chatter circulating right now that we have to touch on.
Oh, the cash pile rumors.
Yeah. They're sitting on that $7.2 billion cash pile. The whispers are that Palantir is looking to acquire niche, agentic AI startups. Now, for you listening, agentic AI isn't just a chatbot that answers your questions.
Not at all.
These are autonomous AI agents that can be given a multi-step goal, and they will go interact with different software programs, write code, and execute tasks completely on their own to achieve that goal.
And integrating that level of autonomous action into their existing ontology, that would be an absolute game changer.
Yeah.
But the even bigger rumor attached to this is a potential shift in how they price their software.
Right, because traditionally, enterprise software is priced per seat, right? A company pays a licensing fee for every employee who logs into the system.
Exactly. But the chatter suggests Palantir might shift toward per outcome or labor as a service pricing.
Which would completely rewrite the unit economics of the entire software industry.
Right.
I mean, think about it. If an autonomous AI agent can independently execute the daily workflow of a mid-level data analyst, why would Palantir charge a $50 monthly software license?
So they wouldn't. They could charge a fraction of what that human analyst's salary would have been.
Right. If they pull off that pricing model shift, their average revenue per user wouldn't just increase, it would fundamentally explode, because they are capturing payroll budgets, not just IT budgets.
Capturing the payroll budget is the holy grail of AI. It really is. But we have to ground ourselves here for a minute. Because if the fundamentals are accelerating and the moats are impenetrable and the macro catalysts are aligned, we have to ask why the stock price isn't just climbing to infinity.
Yeah, we have to address the friction. And right now, the bear case is entirely anchored to valuation, right?
Entirely. Let's look at the reality check. Palantir is currently trading at roughly 216 times trailing 12-month earnings and an astonishing 78 times revenue.
Wow, 78 times revenue. When you trade at 78 times your sales, the stock is priced for flawless, absolutely perfect execution.
Perfection is the key word. When you are priced for perfection, any slight deviation is punished severely.
Right.
If their growth rate were to decelerate from 61% down to, say, 30%, you would likely see massive multiple compression.
For you listening, multiple compression basically happens when the market decides the company no longer deserves a premium valuation.
Yeah.
The underlying business could still be growing, they could still be making record profits, but the stock price crashes simply because investors refuse to pay 78 times revenue anymore.
Exactly. And we are seeing heavy hitters making massive bets on that exact scenario.
Yeah, let's bring up Michael Burry,
Right.
the guy who famously shorted the housing market in 2008. He is heavily bearish here. He is holding $50 strike puts for June 2027 and $100 strike puts for December 2026.
He is actively wagering millions that this valuation cannot withstand the macro environment over the next couple of years.
Which is wild to think about.
It is. Burry's timeline is fascinating too because 2026 and 2027 suggest he is making a macroeconomic bet, perhaps on a broader market pullback that would disproportionately crush high multiple tech stocks.
Right.
It highlights this massive tug-of-war happening under the surface. On one hand, you have major institutional buying. Ever since Palantir was included in the S&P 500, passive index funds, Vanguard, and BlackRock have been forced to aggressively load up on shares.
Because they have to mirror the index.
Exactly. But on the other hand, you have a staggering amount of insider selling.
Yeah, we have to talk about that. In early March, Peter Thiel sold around $290 million worth of stock in a single day.
In one day.
One day. Overall, 9 different insiders have sold a combined $430 million over a 90-day period. And crucially, there have been 0 insider buyers.
0.
But, I have to push back a little on the retail panic that usually surrounds insider selling. Are we overreacting to this?
What makes you think it's an overreaction? $500 million in insider sales at all-time highs is usually a glaring red flag for retail investors.
Well, because management almost always files these as 10b5-1 sales, right? And for you listening, a 10b5-1 plan is basically a pre-scheduled stock sale set up months or even years in advance to avoid any accusations of insider trading. They trigger automatically when the stock hits a certain price or a certain date.
That's true.
Plus, these founders have the vast majority of their net worth tied up in this single asset. Diversifying into other investments is just basic wealth management.
Fair point.
More importantly, if you look at the underlying business health, their Rule of 40 score is at 127%.
Which is astronomical.
Right. The Rule of 40 is a benchmark that says a healthy software company's growth rate plus its profit margin should equal 40. Palantir's sitting at 127. Doesn't the reality of sovereign AI, entire nations realizing they need proprietary AI infrastructure, doesn't that justify paying a massive premium for an elite asset?
Look, a Rule of 40 score of 127% is in the top 1 percentile of all publicly traded software companies. It is an undeniable operational masterpiece. And you're right, the sovereign AI trend is real. Governments cannot risk outsourcing their intelligence infrastructure. However, the friction remains. Is 78 times revenue simply too steep a price, regardless of how elite the asset is?
I hear you.
Even if the sales are pre-planned 10b5-1 programs, the executives still chose to set those price triggers where they did. They are very happy to liquidate at these multiples.
Which brings us to the ultimate question for you listening as we approach this May 4th earnings call. We have extreme fundamental growth clashing head-on with these glaring valuation risks. So what does the technical setup look like, and what is the final wealth-building thesis here?
Well, if you look at the charts, the historical price action shows a massive rally that peaked at an all-time high of $207.52 back in November 2025.
Right after the S&P inclusion.
Exactly. Following that euphoria, the stock really needed to digest those gains. So as of late April 2026, it has cooled off into a consolidation range roughly between $135 and $148.
Okay, so it's settling.
Yeah. We saw incredibly resilient support during the broad market March washout, and the absolute 52-week low remains way down at $89.31. Technically, the stock is just catching its breath, establishing a new floor.
And the institutional sentiment seems to be catching its breath as well, right? Turning bullish right before earnings.
Definitely.
Just recently, we saw a 4% single-session surge as risk-on capital started flowing back into the AI logic layer. And the analysts are definitely stepping up their targets. Oppenheimer just initiated coverage with an outperform rating and a $200 price target.
Yeah, and Rosenblatt is echoing that with a buy target at $200.
Right, and Wedbush is sitting even higher at $230.
So when you synthesize all of this, the accelerating fundamentals, the impenetrable government moats, the defense tailwinds, and this technical consolidation, the final verdict is an 8 out of 10 bullish score.
8 out of 10. Okay.
You really have to view Palantir not just as a software vendor, but as the foundational operating system for the Western AI ecosystem. The core thesis here is that this current consolidation, well below the $200 psychological resistance level, offers a highly compelling entry point.
But it's not a short-term trade.
No, to be clear, this is not a short-term get-rich-quick trade. This setup demands a 12 to 24-month multi-year hold.
Right.
It requires the patience to let the fundamental cash flows catch up to the current valuation, perfectly timed to capture the rollout of these commercial enterprise conversions and the beginning of a major defense supercycle.
It's a long-term play on the structural rewiring of the economy. Listeners, as we wrap up today's Deep Dive, I want to leave you with one provocative forward-looking thought to ponder on your own. We talked earlier about that speculative shift toward labor-as-a-service pricing.
Yeah, the pro-outcome model.
Right. If Palantir successfully transitions to charging for automated outcomes rather than just charging for software licenses, could we see a future where investors no longer evaluate software companies based on their user counts?
That changes everything.
Imagine a world where we start valuing these tech giants based entirely on the actual human job roles their autonomous AI agents have permanently replaced inside the Fortune 500. I invite you to really think about what that means, not just for Palantir, but for the broader structure of your entire portfolio in the labor market in the years to come. Thank you so much for joining the conversation today. Keep learning, keep building, and we'll see you next time.